You bought it at $84. That's the number tattooed on the back of your brain. You check it every morning, not because it matters for what happens next, but because it's yours. That was your entry, your bet, your moment of conviction. Now it's sitting at $61, and you are not selling, not because the business got better, not because you found new evidence, not because Warren Buffett himself called and said hold. You're not selling because $84 exists, because somewhere inside you, selling at $61 feels like losing, and you don't lose. But here's the question that should be keeping you up at night, and it will be by the time this is over. What if the number in your head isn't protecting you? It's the thing that's costing you. Let's go back to the moment you bought it. You did the work, you read the earnings call, you liked the CEO. The chart looked like it was coiling up for something. And when you pulled the trigger at $84, it felt right. It felt earned. The first few weeks, fine. A little chop. Normal. Then it starts to slide. $81. Okay. $76. Uncomfortable. $71. Now you're Googling the company again, not because you're curious, but because you need someone on the internet to tell you you're not wrong. And you find it. A Reddit post, a Substack note, someone who agrees with you. You exhale. $68. You average down. Because at $68, it's obviously a better deal than at $84, right? That's just math. $63. You stop checking as much. You mute the ticker. You tell yourself this is called conviction. Meanwhile, and this part is important, every morning you wake up, the market is offering you a fresh price. $63. Take it or leave it. You're leaving it. Not because $63 is a bad price to leave, but because you cannot get $84 out of your head. It lives there like a ghost. And every decision you make about this stock, hold, average down, ignore the news, is made in that ghost's shadow. Here's the bias. It's called the sunk cost fallacy, or in investing, its more dressed up cousin, anchoring to cost basis. And it's not a thinking error. It's a feeling error disguised as logic. Your brain genuinely believes $84 is relevant information, that because you paid it, it means something about what the stock should do next, that the gap between $84 and $61 is a debt the market owes you. The market owes you nothing. It never did. Here's what actually happened when you bought at $84. That money is gone from your life. The $84 per share is a historical event. It cannot be undone. It doesn't know it was your price. The stock does not know it was your price. The CEO doesn't. The market makers don't. The only entity in the entire world that cares about $84 is you, and it's quietly running your decision-making. Think about what you've actually been doing. Every week you hold this stock, you're making an active choice to buy it at $61, at $58, wherever it sits today. Because holding is choosing. You could sell today, take the cash, and put it somewhere else. Every day you don't. You're rebuying this stock with the money you could have somewhere else. Would you buy this stock fresh today, with fresh money, no history, no $84 tattoo on your brain? If the answer is anything other than a clean yes, you're not holding because of the business. You're holding because of a number. There's a name for what this cost real investors. In 2000, people held Cisco from $80 all the way to $11, waiting for their price back. In 2008, Lehman holders averaged down to zero, not because they had better information, because selling meant admitting the gap was real, and that felt like losing. The loss was already real. The gap already existed. The only question was whether they were going to add more good money to the story. Here's what Buffett actually does. He has a rule so simple it sounds stupid until you really sit with it. He asks, if I didn't own this, would I buy it today? That's it. Not, what did I pay? Not, how far down am I? Not, when will I get back to even? Just, knowing everything I know right now, is this the best place for this capital to be? If yes, hold. If no, the business tells you what to do, not the price you paid. Munger put it sharper. All you have to do is not be a fool. The fool is the person who treats a past decision as a reason to make a future one. The unlock is this: your cost basis is your problem, not the market's. The moment you paid $84 is over. The only real question, the only one that has any power over your future returns, is what this business is worth right now and what it will be worth in 5 years. Everything else is noise with a number attached to it. When you sell at a loss, you are not losing. You already lost. You are deciding where your money goes from here. That's not defeat. That's control. Here's the one thing to do this week. Pull up every stock you're holding at a loss. For each one, write down the answer to this question. No hedging, no caveats. If I had fresh cash today, would I buy this at the current price? If yes, write down why. That's your real thesis, and it should stand on its own without $84 in the room. If no, then you already know what this is. You're not holding an investment. You're holding a number, and there's a reason that's so much harder to let go of than it should be. Next video, we go deeper into why, specifically, why your brain treats a paper loss and an actual loss as completely different things, even when the math is identical. It's called loss aversion, and once you see it operating inside you, you can't unsee it.